You're watching a power play unravel right before your eyes, a move so bold, yet shrouded in opaque maneuvering that it's left analysts and investors in a frenzy. Kevin Warsh, once a governor on the Federal Reserve Board, found himself unexpectedly thrown back into the spotlight. This isn't just any nomination, it's a seismic shift. When former President Trump dropped his name for the Federal Reserve chair, the financial world had to recalibrate its instruments overnight. The nomination wasn't a mere reshuffling of personnel, it was a declaration of intent. Warsh is no passive figurehead. He's an architect of chaos, a maestro of monetary tightening. His precedent indicates an embrace of hawkish monetary policies that threaten to pull the rug from under the inflated asset bubbles nurtured by years of dovish Fed strategies. If you didn't feel the ground shift, you weren't paying attention. Market expectations smashed to pieces. Some wield rose-colored glasses, mistaking Warsh's unpredictably decisive stance for a continuation of status quo. They couldn't have been more wrong. This was an aggressive move to plug the liquidity festival that had become the Fed's norm. The second Warsh's name entered the mix, the bond market started whispering its fears. Yields on the 10-year U.S. Treasury notes crept upwards ominously, a prophetic song of impending tightening and market asphyxiation. But there was more to this unfolding drama. The dollar index, DXY, responded with an upward lurch, recognizing this pivot from monetary indulgence to potential austerity as an unequivocal rallying call. Your screens blinked with flashing alerts. Commodities flinched. They know too well the pain inflicted by a strong dollar, every tick upward adding weight to an already burdensome pressure. Warsh may not have yet laid a finger on the Fed's control levers, but the anticipation of his influence sent tremors across the globe. Silver, the oft-overlooked glint amidst the precious metal cohort, stood metaphorically at gunpoint. No safe harbor here. Rising Treasury yields made sure of that. The markets didn't need to guess who was pulling the strings. The script was being written openly for those who dared to see. If you're feeling the paranoia, unsure where to stash your assets for safekeeping, you're not alone. But understand this. Behind the curtain, it's not just a political game. It's a calculation, a realignment, a reversion to sanity amidst fiscal profligacy. Those who clung mindlessly to the propaganda of endless resources and liquidity are now being handed their reality check, courtesy of Warsh's potential ascension. Welcome to the Fed's trap. Prepare for its jaws to spring shut. Chapter 2. Laying the foundation. If you think the bloodletting in the markets is just a phase, you're sorely underestimating the depth of this machination. The trigger may have been Warsh, but the groundwork for this upheaval was laid long before his nomination ever hit the headlines. Consider the data, hard, cold figures that paint a picture of strategic tightening that the average pundit would overlook. 10-year U.S. Treasury yields didn't just rise by chance, it was a deliberate choreography of federal balance sheets and interest rate expectations. This wasn't just a market hiccup, it was a structured symphony moving towards crescendo. The dollar index, DXY, that little number that sways currencies and sends ripples through the commodity sectors, isn't climbing without a reason. Its ascent signals a punitive stance against loose monetary policy, a breath of fresh air for some, and asphyxiation for many. The dollar's strength is a noose tightening around the global supply chain's neck, threatening to choke emerging markets reliant on weaker currencies. When we dissect commodities, particularly silver, we're not just observing price movements. We're witnessing a tactical war. Rising yields sink their claws into commodity markets, turning once promising assets into toxic holdings. Silver felt the icy grip of this financial Arctic blast as investors turned skittish, their faith in its safe haven status cracked under the pressure. But why now? Why is silver, this industrial and precious hybrid, under such siege? Because in the midst of a liquidity vacuum, few are willing to take the gamble. This is not just a financial shuffle, it's a clear message: adapt or be left behind. Traditional haven assets must now contend with a world where fiscal profligacy is no longer tolerated. A world that Warsh is eager to sculpt with his hawkish scalpel. You might dismiss these movements as temporary disturbances, but the meticulousness with which these financial elements align signals the exact opposite. This foundation isn't weak. It's a fortress being rebuilt, stone by stone, under the pretense of tightening monetary strategy. The result? An economic battleground ripe for winners and losers. So, as you sift through the rubble of falling markets and rising yields, remember this: the foundations were never meant to be kind. They are the hard, relentless underpinnings of a new economic regime, one that rewards the audacious and crushes the complacent. Welcome to the second act of the financial thriller where complacency dies and strategy reigns. Chapter 3. The plot thickens. The flickering screens of Wall Street are the glowing embers of a narrative that shifts with each tick. Yet, Kevin Warsh's hawkish approach wasn't a deviation. It was the preordained path of a master architect of chaos. This was no spontaneous eruption of market anxiety. This was an orchestrated cacophony meant to realign the financial symphony under a new draconian baton. If you're mistaking the rising treasury yields for wind in a storm, you're failing to see the invisible hand that's pushing them relentlessly upward. This isn't natural market movement. It's a strategic elevation designed to create an investment vacuum where the gravity of expensive capital dissuades risk and breeds reticence. The treasury market hadn't just woken up. It was shaken violently back to life, tearing through portfolios with the efficiency of a scalpel. Silver, once a stalwart among time-honored safe havens, now tumbles from grace, tarnished not by intrinsic value but by perception manipulation. This newfound toxicity, it's the byproduct of a monetary environment where hawkish whispers bloom into reality, prompting investors to retreat from anything perceived as remotely unstable. As silver's allure dims, the metal finds itself in the crosshairs of a crafted narrative, one where rising rates vindicate new champions and declare old reliables expendable. The time frame for this unsettling shift isn't a mere blip on the radar. Market analysts, with their noses pressed too deeply into streamlined data, miss the broader picture. Warsh's strategies are set to unfold in crescendo, adapting with the precision of a blade designed to cut deep. But only at the opportune moment. The Fed's tightening isn't a hair trigger, it's a loaded mechanism, primed to fire as the global markets place their bets on false expectations of perpetual dovishness. In this landscape of fiscal skepticism, you're witnessing more than just policy realignment. You're observing a deliberate distortion. As yield pressures tighten their grip, commodities like silver become collateral damage, casualties in a conflict carelessly dubbed as market correction. What media casually labels an anomaly is in fact a ruthless eradication of complacency. Remember this, every tick in rising yields, every trembling fall of silver is not merely reactionary. It is a prescripted chapter in the grand opera of capital, where you, the observers, must choose your roles wisely. In this game, the spoils go to those who decode its cryptic directives, and the punished are those who scorn foresight. Welcome to a new era, where hawkish winds erase innocence, and the price of failure is written in your plummeting portfolios. Chapter 4. Emotional response investors, brace yourselves. As we wade further into this engineered quagmire, a tsunami of disappointment crashes across the markets. You've been groomed by years of dovish illusion into a state of naive expectation, a fatal charm offensive that left you vulnerably optimistic. Now the reality strikes with an emotional resonance that could crumble empires. The promised land of perpetual growth is nothing more than a desert of exhausted hope. The cold hand of disenchantment grips your portfolios as you witness the very foundations of fiscal strategy erode. The bitterness of betrayal permeates the air. It's the twisted epiphany that what you've so carefully fortified is now at the mercy of an unyielding authoritarian shift embodied by Kevin Warsh's hawkish ascent. The euphoria that once drove your convictions now feels like a distant echo, replaced by the stark reminder that markets are inherently volatile beasts, tamed only temporarily by the seductive lull of low rates and cheap capital. Watch as complacency morphs into a wave of caution. The bargaining phase of loss has begun, characterized by frantic recalibrations and a desperate clamor for safe harbor assets that no longer exist in this war zone of liquidity. The orderly exit envisioned by early retreaters is a mirage within a bottleneck, as the masses trample each other in a panicked flight to financial safety. The market isn't merely correcting, it's reshaping, coerced into a new form where investor sentiment is the clay in a potter's wheel turned by unseen forces. The spine-chilling realization is dawning. Traditional metrics no longer serve as reliable guides. Sentiment indicators run wild, reflecting not rational thought but the primal urge to survive a financial tempest of unprecedented design. As your gaze shifts to ETF flows, you see a violent oscillation between fear and misguided hope. Each surge and retreat marks a collective psychic upheaval, a traumatic response to the Jeremiad unfolding before you. Unhedged positions are liquidated in droves, raw nerves exposed by the dispassionate scalpel of market ruthlessness. In this landscape, control is a privilege granted only to those quick enough to recalibrate their strategies. Understand this, emotional resilience is now the linchpin of market survival. It's the ability to withstand the relentless hammering of your convictions by unforeseen policy shifts and geopolitical upheavals. Remember, the illusion of stability was always just that, an illusion. Now, as the architects of chaos scribble their adjustments in real time, you stand at the crossroads of your financial destiny. Choose wisely your path, align with this new paradigm, or be swept away by the tide of your own expectations. Welcome to the heart of the storm, where wisdom is extracted from the marrow of market madness and inaction brands you with the scarlet letter of obsolescence. Chapter 5. The Perfect Storm. If you think you've seen market turmoil before, you're not prepared for the tempest brewing on the horizon. It's no mere squall, but a force ready to obliterate complacency and erode false confidence. You're poised at the heart of a liquidation cascade, a term sterile enough to downplay its brutal reality, but powerful enough to induce nightmares for any investor who dared to wade too deeply into the waters of optimism. Here's what the crowd doesn't see: the hidden architecture of chaos being meticulously engineered by a confluence of macroeconomic shifts, regulatory overhauls, and geopolitical tremors. You're being led to focus on distractions, a misdirection worthy of any seasoned illusionist. But behind the curtain lies the real plot, a manipulated environment ripe for a cataclysmic realignment. U.S. policy changes enact the first tremor, orchestrated at the highest echelons, masked by promises of stability. Kevin Warsh, with his hawkish tactics, has shoved you onto a roller coaster with loops never foreseen in the script of dovish discipline. Imagine the bond market as the canary in your coal mine, chirping warnings through rising treasury yields, a cold reflection of eroding confidence, or a risk premium inflated by fiscal myopia. But this tale is not confined to American shores. Chinese regulatory moves inject their potent strain of disruption, a relentless tightening on capital flows, a prudential measure camouflaged as self-preservation, but serving as a barricade against transfers that once greased global commerce. Look no further than increased margin requirements on the Shanghai Gold Exchange as a harbinger of constrained liquidity, a surgical strike on physical silver demand yet to ripple through your spreadsheets. In this weary dance, geopolitics figures as a silent composer, pulling strings with its own cryptic motives. Iranian tensions surge anew, each ripple a potential trigger, coaxing safe haven investors into a frenzied exodus toward perceived shelter. Yet the irony is palpable as the fortress they seek is itself fraught with uncertainty and exposed vulnerabilities. With these elements aligned, the stage is set for devastation masquerading as a market reset, an apocalyptic vision where traditional safe avenues metamorphose into traps. Liquidity evaporates in this parched landscape, a fleeting mirage you'd swear you saw yesterday, but now seems like a cruel figment, absent from today's stark reality. This maelstrom of change is more than a test of your financial acumen. It's an existential interrogation of your adaptive capacity. Will you endure navigating these rapids as others flounder? Or will you be subsumed, a footnote in the annals of speculative history? The answer lies not in the spreadsheets or predictive models, but within your hard-earned mettle and ability to pivot amidst chaos. As the storm gains momentum, dare to recalibrate now, before the deluge reveals which structures were castles of sand. Chapter 6. Understanding Silver's Volatility. Silver, the ever-elusive commodity, forever playing the dual roles of cherished asset and cursed liability. What you might see as mere market fluctuation is, in fact, a meticulously orchestrated ballet of price manipulation, engineered by forces intent on maintaining equilibrium in a structure built on fragile trust rather than substance. You won't find this theater of chaos on the front pages or in mainstream analyses. You're expected to overlook it, consume the superficial, and continue as pawns in a grander scheme. At the heart of this storm lies structural volatility, an enigma deceptively cloaked in the language of market dynamics, but in truth rooted in profound systemic fragility. High-frequency trading algorithms, worshipped by Wall Street deities, capitalize on every whisper of a shift, transforming it into a self-fulfilling prophecy. These dramaturges exploit microsecond decisions, reinforcing a vicious cycle of volatility that leaves you, the average investor, in its wake, dazed, confused, and most importantly, devoid of power. Silver's price swings are no mere consequence of supply and demand mismatches. They are the direct result of deliberate market interventions. Take, for example, the inexplicable surge in silver contracts on the COMEX, an apparent bloodbath in digital documentation that alludes to a short squeeze triggered by institutional plays hiding behind retail facades. The market is viciously squeezed. fostering a false narrative of shortage, when, in fact, it's a subterfuge executed with precision, trapping unwary investors in a web of deceit. Your concern over silver's spot price volatility misses a more insidious phenomenon: the manipulation of options markets. It's here, in this arena of derivatives, that true power brokers wield control, not through overt transactions, but through implied volatility strategies. The volatility index, VIX, spikes, ostensibly signaling fear and caution. Yet, in this insular ritual, it's also a catalyst for speculative fervor, masked as genuine market reactions. The broader implications extend beyond mere financial loss. Silver's erratic dance isn't just about price tags, but reflects the deeper erosion of confidence in a monetary system teetering on its precipice. Each fluctuation is not just a flicker on a Bloomberg terminal, but a resounding gong heralding gale forces, threatening to tear through macroeconomic fabric, exposing the arbitrage vacuums authors try to sidestep and economists dismiss as theoretical relics. Yet, with your eyes wide open, you can decipher the real narrative, the asymmetrical power dynamics at play, leveraging silver's twin identity, both as a conduit of electrical charge in your digital gadgets and as an epoch-spanning safe haven asset. Ask yourself who benefits from this uncertainty, and more importantly, why now? The unrelenting fiscal policies, feverishly printed by central banks, and geopolitical tensions of red-hot iron are all symptoms, while the disease of currency devaluation and spiraling debt ceilings are ticking time bombs carefully concealed by market actors. The illusion of stability is maintained by a fragile alliance of players perpetuating an unsustainable myth. In the twilight of this financial shadow play, knowledge is your shield. Recognize the broad strokes of orchestration in silver's volatility as a portent of systemic recalibration, one that forces a hard reevaluation of the roles played by physical commodities in our hyper-financialized global village. The crisis isn't on the horizon, it's embedded in the now, if only you dare to see it. Chapter 7, The Euphoria of January 29. If you thought the silver market's fevered crescendo on January 29th was a spectacle to behold, then you've merely scratched the surface of this orchestrated charade. What you witnessed wasn't just a typical market rally, it was a brutal psychological assault executed with surgical precision. You, along with countless eager investors, were drawn into a meticulously crafted narrative of FOMO, a fear of missing out, engineered by shadow players lurking in the market's underbelly. On this fateful day, silver's price didn't merely rise, it catapulted into a sphere of euphoria. The catalyst for such a volcanic eruption wasn't pure demand, nor the simplistic supply-demand dynamics trumpeted by headline regurgitators. Instead, it was a masterstroke of manufactured scarcity, spun like a web by those who thrive in tumultuous waters. Silver's ascent was propelled by derivative contracts, piling up in unprecedented numbers, furiously inflating the balloon of illusion. You see, high-frequency trading algorithms pummeled the market with a tidal wave of automated buys, minutely calibrated to tip the balance in favor of rampant speculation. They weren't acting at random. These algorithms were precise instruments, the scalpel in the hands of market architects who understand the fragility of human emotion. By exploiting these primal fears, the market maestros siphon liquidity, leaving retail investors clinging to meager threads of expected returns. This contrived rise in silver was not about genuine value. It was about manipulating perception. Institutions with deep pockets and blank checks enacted a breathtakingly coordinated raid, driving prices to dizzying heights while lining their coffers with profits skimmed off the ensuing chaos. The illusion of a bullish trend played out like a symphony, a crescendo followed by an inevitable crash, waiting patiently to lay its trap. And in the thick of this chaos, retail investors naively poured in, swept along by the infectious optimism that gripped social media and financial news channels alike. The retail rush, personified by dizzying spikes in Google search intensity and explosive discussions in digital trading forums, was no match for the seasoned precision of institutional narrative weavers. But why January 29? Because timing is everything. A deliberate spike designed to capitalize on the primal greed that emerges at the dawn of a new fiscal quarter. Institutional speculators knew exactly when to strike, wielding calendar cycles as potent weapons. The window of quarterly adjustments, where hedge funds and other large players balanced their portfolios, provided a fertile ground for their covert machinations. They whisper among themselves in the corridors of shadowy boardrooms, the architects of chaos who see the market not as a spectrum of value and trade, but as a chessboard, each piece strategically positioned for maximum yield. Their tools aren't quaint notions of value investing, but sophisticated strategies of psychological engineering. Your role in this grand illusion? A pawn, if you remain passive. A tactician, if you choose to unmask the orchestrators of these market-bending games. You must see past the veil of short-term gains and ponder the structural recalibrations looming on the horizon. The stage is set, the players are in position, but the script, well, the script is yours to rewrite if you dare to wield the pen.